Good morning. This is Mitch. It's about 11 minutes after 10 on Monday, August 8th, and I am going to be recording a quick video describing how I look at a Section 8, how I look at a seller finance deal. I'm using a deal that was submitted by Daryl. I'll put a link to his original post in the post for this video. He's got a Section 8 duplex that he's looking at in the Metro Atlanta area, and he's trying to figure out what price he should offer, what terms he should offer on the seller financing deal. So we've already got our spreadsheet lined up with the A to B transaction, which is between us and the seller, and the B to C transaction, which is between us and the investor. It's set up as a wholesale transaction so that we can at least see if that's a possibility. And I'm going to run the numbers so that we can take a look and see if there's opportunity here. So first, let me just say that I typically work these deals from the back forward. So I look at how the deal looks from the standpoint of the investor, and then I can play around with at what price I need to buy it from the seller. So let's start with the B2C in mind, and let's play around with some of the numbers. So the main three numbers that you are going to be concerned with in a seller financing transaction are going to be the price that you're going to buy it from the seller at, or in this case, the price that the investor is going to buy it from us at. But price, down payment, monthly payment. There it is, monthly payment. Those are the big three. Price, down payment, monthly payment. If I know those, I can start to calculate. And I know one other thing, but I'll talk about that in a minute. But if I know those three things, I can get a sense for what kind of cash-on-cash return and what kind of cash flow I'm looking at. So I'm going to stipulate for now that the expenses are correct. So I'm not going to question any of these expenses. These are the same as they are up here. So I'm just going to accept these on faith that they're correct. And so I'm going to start fiddling around with those big three: the purchase price, the down payment, and the debt service. Let's start with purchase price. I know from up here that the ARV is $439. Let's plan for now to keep that around $439. Let's not try to get too cute with the purchase price. Down payment, I have it at $45,000, which works out to be about 10%. In fact, in the interest, well, let's keep it at $45,000. And so at $45,000 and $1,300 a month, we actually get a 10.27% cash-on-cash return and $600 a month in positive cash flow. That's not a bad deal. That means our all-in for this deal is $45,000 to down, $20,000 to repair it, and then $10,380 to close it. That includes 2 points to on the paid by in this case, the investor, to us, the seller. In this case, actually the wholesaler, but we're selling it to the investor. So from their perspective, we're the seller. I'm actually going to bump it up to 3 points because this price range, 3 points is probably not unreasonable. So I'm going to earn the wholesaler selling this to an investor is going to collect $22,500 in wholesale fee. We'll explain why that's that in a minute. And they're paying $1,300. So this is acceptable. 9.76 is not that bad. It went down just now because I increased the closing costs. But let us play around with this. Let's bump this up to, because we're offering financing, we can ask for more than ARV. So let's try 445. Sorry, 4,500. Sorry, 450. Thank you. Okay, 450. Now, of course, you saw I didn't change the cash on cash, right? Because this is just the purchase price. They're not paying that at closing. They're paying this at closing. But I want to bump this up a little. But I'll do that later. Let's focus on this. Let's have them pay us a little bit less. Let's try this at 1200. Okay, let's try with 12. So 1200 got us to 11.22. That's a little bit less than, a little bit more than I need to offer to an investor. So let's try 1150. Okay, that's still too high. 1100. Went the wrong way. 1250. It's early. I haven't had my coffee yet. Okay, so 1250. We can, if an investor pays 45,000 down, 20,000 in repairs, and 14,650 in closing costs, and 1250 a month, then that investor is getting 10.47% cash on cash return, which is awesome, and they're getting nearly $700, $695 in cash flow. Let's start with that for now. Let's take that and work our way backwards. So now we know that we're collecting $1,250 from each month from the investor, and that we are receiving $45,000 down at the time of closing from them. That means we have to make sure that we're paying our investor less than $1,250 and less than $45,000, because we don't want to have to come to closing with cash. We're going to use the investor's cash to complete our transaction. So in this case, let's keep that price at $439, but let's drop this down payment. Let's keep the down payment at $20,000, because that's obviously less than $45,000. That's appealing. Now, they may not go for that, but let's at least start there. And let's make the debt service an even $1,000. Okay. So at $1,000, we are, if we kept this deal ourselves, if we paid $20,000 in down, $20,000 in repairs, $2,500 to close it, and I paid them $1,000 in monthly payments, our cash on cash return would be an eye-popping 26.68%. And we'd have a $945 a month cash flow, which is pretty darn good. One could argue that our work is done here, in the sense that we at least have a starting offer that we can make to a seller. That's the purchase price, that's the down payment, that's the monthly payment. And we know this, if we do $20,000 down and $1,000 a month, we know that we're going to be okay, because we're going to, at closing, we're going to pay them $20,000, but we're going to collect $45,000. And that's why we're going to see a spread of $25,000 at closing, just on the down payment. We're going to collect $45,000 in the B to C. We're going to have to pay $20,000 of that in the A to B, and that leaves $25,000 in wholesale fee for us. So you might ask, well, then why is this $2,250 instead of $25,000? Well, because we are agreeing to pay when I do these transactions, I agree to pay the closing costs for the seller in the A to B transaction. So that $25,000 is reduced by $2,500, because I'm going to cover these costs, and so that's why it's $2,250 and not $25,000. But still, that's not a bad payday. And again, the investor gets a great deal, and because we're collecting $1,250 and only paying $1,000, then if I did this transaction, I'd stay in the middle and collect $250 a month in cash flow as the second lien holder. And so I'd make money at the closing. I'd make $22,500 at closing. I'd make $250 every month, and this would go on until they paid me off at some point in the future. And when they paid me off, then I would pay off the seller, and then I could potentially make some money on that as well. But to answer Daryl's initial question, how do I decide how much I want to offer to the seller? This is the answer. I start with what I can offer to the investor, what I want to offer to the investor, and then I back into, well, if I offer that to the investor, how much can I afford to pay to the seller? Now, you might ask the question, well, what is this $1,000? That's $12,000 a year, right? $1,000 a month, and that works out to be 2.86% of the balance on this, Because again, we're offering to pay $439. We're paying $20,000 at close. That means $419 is the balance. $439 minus 20. So $419,000 is the balance, and at $12,000 a month, that's 2.86%. What I have not discussed is What I have not discussed is how this $1,000 in payment to the seller will be treated versus this $1,250. Let me just say this real fast, and then I'll end the video here. We can talk about this in more detail. When I'm arranging seller financing, I'm trying to set it up so that the payment that I'm making to the seller is pure principal, so that this $1,000 reduces the principal by $1,000, that $1,000 payment. So in a year, my payment, my loan balance would go down $12,000. If I do that, I am getting myself a 0% loan. Even though this says 2.86, this is the assumption as if all of this were interest. How about if none of this were interest? How about if that full $1,000 were going to reduce the balance? That'd be awesome. And that's what I typically ask for. Now, if I can't get it, that's fine. I'll try to work something else out. But that's what I'm going to ask for initially. That's on the A to B side. On the B to C side, it's exactly the opposite. This $1,250 that they're paying is 100% interest. It's an interest-only payment. And at that interest-only payment, that works out to be exactly 3.7% interest annual. That's great, right? Because that means the loan balance to this investor, which works out to be $405,000. $450 minus $45,000, so $405. That loan balance won't change a penny in year 1, year 2, year 10, because they're not paying anything towards the principal. They're only paying interest. And so when it comes time to close this thing out, this loan balance will still be $405, and this loan balance will be getting smaller by $12,000 every year. And so at the end of, say, 10 years, this will be $120,000 smaller. This will be exactly the same. That means I'm going to get paid again when they cash me off. Let's say we got a 10-year note. When they cash me off in 10 years. I'm throwing way too much out there, so I'm going to stop it now and at least get you comfortable doing this kind of analysis. So we're going to do the B to C first, work our way backwards into the A to B, and then start the negotiation with what we'd love to have. I'd love to have this. Am I going to get it? Who knows? But at least if I start with this, then I know that I could happily live with this in a wholesale transaction, because my investor will be delighted to get 10.47% cash on cash and $695 a month in cash flow. All right, that's it. If you have questions specifically about this approach, please post them below in the comments section, and we'll talk more about seller financing soon. Bye.